All right, we are live.
All right. We'll just give it a couple seconds here just for people to roll in, and then we'll go ahead and get started.
Sounds good. David, I like your new background you've got going on. You really spruced it up over there in your office.
Yeah, it's a little bit of a work in progress, but it's coming along nicely.
That's all right. It's looking
So
good.
thank you. While everybody's joining in, we'll just go over a couple things. I'll probably repeat this a couple times just as more people enter. Essentially, for today, we're going to be having our June market commentary. The presentation is going to be recorded and will go live on our YouTube channel shortly after the presentation. Uh, for the chat feature, for anybody who would like to chat throughout the presentation, it does require you to have a YouTube account. If you try to sign into your YouTube account while we're presenting, it's going to kick you out and have you essentially have to come back in. So if you would like to chat, now would be a great time to sign into your YouTube account. Otherwise, if you don't have one, what I would suggest is maybe after today's presentation, you create an account, and that way you'll be able to chat in some of our future presentations. Of course, if you have any questions, you can certainly use our website to contact us and ask any questions if you don't have a YouTube account as well. Um, the slides are also going to be up as well on YouTube on the recording. So if there's anything that you missed or you want to come back in and rewatch, then you'll be able to go to that YouTube channel. And then, as always, we'd heavily appreciate if you could share this with any of your coworkers, friends, or family that you think could benefit from the information we'll be going over today. A little bit of background of myself. I'm a chartered mutual fund counselor with Capital Financial Planners, or RETFed, and I have over 10 years of experience dealing specifically with federal employees. And I'm joined here with my counterpart, Austin Costello. He's a CFP, Certified Financial Planner, and he has over 6 years of experience, most of which dealing specifically with federal employees as well.
Yep. All right. Thanks, David. Yeah, without further ado, I think we're just going to jump into it today. And if you've been sitting on some of these market commentaries, if you've been watching them on YouTube and seeing what we've been talking about, what we really try to do throughout these presentations is give a glimpse at what's going on in the broader economy. Sometimes we cover things really broadly and cover a lot of ground. Sometimes we cover more specific topics. And today is going to be one of those times where we dive a little bit deeper into a specific topic or conversation that's going on right now in the market. And what we're going to be talking about today is this interesting disconnect that's happening between how the majority of Americans feel the economy is doing and what the data and what the stock market is showing to be happening. And this poll went out a couple weeks ago, done by a company called Harris, and there were a couple data points that really stuck out to us and we wanted to highlight today. Point number one is that in this poll, 55% of people that were polled thought the economy was shrinking, and 56% thought the U.S. was currently experiencing a recession. Interesting, because over the last year and a half, the economy has been growing, GDP has been growing. 49% of the people that were polled thought the S&P 500 market was down for the year, okay, 6 months into 2024. In reality, the market was up over 20% last year and is up more than 12% year to date. 49% of people thought that unemployment was likely at a 50-year high, even though it's actually near a 50-year low at about 4%. So what's happening? What's causing this disconnect? This is a massive gap in what's actually happening and what kind of the average person feels like is happening. And to add to that, we just want to we just kind of want to show what's happening and why people may be feeling this way. So the first thing that I wanted to show here is a major piece of how people feel about the economy, their spending, of course, is how expensive things are. In particular, how expensive houses are, housing expenses. And when we look at the economy as a whole, and the debt that the U.S. holds, generally, housing costs are one of the largest, if not the largest, source of debt. What we've been seeing happening, though, recently is that back in 2019, 2020, 2021, if you had a mortgage at that time, there's a good chance you refinanced it, right? Interest rates were at all-time lows. You could refinance a mortgage, get a lower rate. And so the mortgage debt portion of our spending went way down. And you can see that highlighted in orange here from 2008 and on. It's been declining as interest rates were low and people have been refinancing and getting to a lower percentage. Now, what's been a bit startling recently is what's highlighted in blue here, which is the consumer debt. Okay, so this is all debt other than mortgages. This is credit cards, student loans, auto loans, things like that, has been doing the opposite, right? It's been growing here as things get more expensive. People have trouble affording things and are taking on a higher percentage. The reason that hasn't impacted the economy as much is because when you look at the financial obligation, so the overall debt in the economy compared to what's coming in, that's actually near a low point here, okay, in black. So the overall debt that's held by the U.S. consumer is low, but there's this disconnect between people that own homes and people that don't. And people that don't own homes are really struggling at the moment and taking on more debt. Another way to show this is specifically looking at credit card delinquencies, okay? And not just looking at delinquencies, but looking at delinquencies in historically poorer neighborhoods and historically richer neighborhoods. You can see in the more wealthy zip codes here in yellow, yes, there has been an uptrend here, but it's at a substantially lower starting point and is really, hasn't changed much since the 90s, right? As opposed to the poorest 10% of zip codes, starting at that same point and going over, and especially looking at over the last handful of years, there's been a significant increase in credit card delinquencies as things get more expensive for, again, people that are renting, people that aren't owning homes. So we're starting to see this play out where there's this disconnect in what people are feeling and what's happening in their lives versus what's happening in the overall economy.
Yep. So a little bit more background on this is, really it has to do with the amount of savings, right? People are running into more debts that they're unable to pay. There's, a higher amount of repossessions of cars and various properties. And the reason for that is that the excess savings that people accrued during COVID have finally run out, right? We had a significant amount of excess savings with people being, forced to stay in their home, not being able to travel, go out to the club or bar or restaurants. So the entertainment and a lot of those other areas were decreasing for a couple of years, and we saw what happened to savings. And ever since things really reopened, right, we've been on this pretty steep decline, and we have now entered negative territory, which is really where those credit card delinquencies are coming up. And we're starting to see that more and more with just people that we are meeting with after presentations, where we're seeing more credit card debt. We're seeing more high interest credit card debt at that, right? Things in the 20+%. And there's a lot of issues that come around surrounding that, not just with their retirements, but at a certain point of debt, right? Somebody can no longer afford to continue spending this way. right? Which means if less people are spending money, then companies' earnings are going to start to dwindle down a little bit, or their at least forward projections will slow down, and we'll see the economy start slowing down in turn as well. So that's kind of one of the major components. And then, how that kind of feeds into inflation here is what people are spending money on and the different costs or demand there. So in the past 12 months, things have really switched around from where they were before. Auto insurance was actually the top gainer in the past 12 months. But the other ones, the next two are really what we want to highlight here is the rent and housing, right? Because there are two main parts of inflation that have really stuck around that we are waiting to go down before the Federal Reserve will finally start to cut interest rates. And that is what they call shelter costs, which would be rent and housing, which were the second and third top gainers in the past 12 months. And food was the secondary one. So those are the two main costs that have really stuck around. And some of the food prices kind of go hand in hand with oil and gas prices fluctuating with shipping costs, but also just production. So those are some of the things that we've really seen go up. So we're going to more so focus on rent and housing, just because that's the more predominant one that has stayed higher. And while that has increased in the past 12 months, more so in the past 6 months, the amount of that increase has really gone down, which is a good sign. The other thing is this is considered a stickier part of inflation, meaning it sticks around higher for longer because most people aren't paying month to month in rent, right? They're signing a 12-month or 24-month lease, where it takes time for those leases to mature and for new leases to be signed and for those prices to either come down or at least maybe not go up again. So that's what we're starting to see, that inflationary number come down. And what Austin's going to talk about here on the next slide is really what's going on more specifically in the rental and housing market.
Yeah, and one thing to add to your point there, David, and we don't have a slide on this, but something that's kind of interesting to note is the supply of new homes has really grown over the last year or so, and there's more and more sitting on the market, and part of that, something that's interesting, is when the housing market was booming, all these new homes were being built, which is exactly what we need. But they're being built at the highest price points, right? So sometimes it takes a while for that to work itself through the system, where yes, there are homes available now. It's just, they're at these higher price points where, people are going to have to move, which causes them to, which makes them have to leave a 2.5% or 3% interest rate to go buy something else. And that's something that a lot of people don't want to do. And, that's what we're talking through here, is about a third of people who actually own a home right now don't have a mortgage. So think about that. 65% of the US owns a home, and a third of those homeowners don't have a mortgage. If you don't have a mortgage right now, it's a pretty tough time to want to move somewhere else where you're then going to take on a mortgage at 7.5%, right? And that's, again, just raising the barrier of entry for these people who are renting. And with home prices staying up higher, instead of someone selling their house, they might rent it. And, sure, that'll increase maybe the rental market, but it's also not doing anything to help decrease these housing costs. To go along with that, right, we've got, we talk about these interest rates at 7.5%, 7.5%, 8%. But in reality, the number of people paying that rate is pretty low because of the fact that people are sticking around. So when you see, the market rate for a 30-year mortgage is up here close to 8%, but the average rate of all mortgages is still below 4. So if rates are staying in this higher for longer area, it's going to take a while to work out these kinks that we've developed by raising rates so fast. And like David mentioned, right, we're moving in the right direction here. When you're looking at the inflation numbers, right, we're nowhere near this peak where we were a couple years ago. We're heading down in the right direction, but this doesn't mean prices are decreasing. It just means they're increasing less quickly. So, we're still at over 5% inflation year over year in housing costs. And this is really going to need to keep trending downwards for us to get substantial movement in this direction. So, not, we don't beat a dead horse here. Everyone kind of understands the impact of interest rates on the housing market and all of that. But David, how does this housing market also kind of, what are the specific ways it plays into the economy as a whole?
Yeah, sure. So, one thing that's just kind of mentioned on that prior slide here is, like Austin said, this is coming down. We want to remember that the Fed's target here is that we get overall inflation down to 2%. So we have in the housing market really a long way to go. Now, housing doesn't necessarily need to get to 2%, right? But it certainly needs to get at least down below the 4, if not even to 3%, where maybe some of the other areas of inflation can be below 2, so that the average comes to 2 at the end. So we have a ways to go. We should probably see some bigger changes happening when rates start going down, because more people will finally be willing to move. But that's also going to increase into the price of homes. So, one of the questions we always get in our meetings is, hey, is, another 2008 going to happen? And the thing is that the circumstance here is completely the opposite of 2008, right? 2008, we had a high supply and a low home price. Here we have a low supply and a high home price. So as far as things go, we're not foreseeing there really being this housing correction, because we would need so many new homes for the supply to meet the demand. So for anybody on the sidelines about moving or buying their first home, really, you're not going to find this better opportunity in the future, because even if rates come down, you're going to see higher home prices. So the better thing would be buy while the interest rates are higher, and then refinance as those prices come down. Now, kind of jumping over here to CPI, Consumer Price Index, which is how we in the Federal Reserve measure inflation. What we've seen here is the headline and core inflation numbers have kind of really consolidated together, right? They're actually very close to each other. Whereas back when we had all these very high inflation readings back in 2022, we had headline much higher than core. So some of that additional volatility has gone down, which is great. And we've really seen that trend downwards. But there is still a ways to go, right? Looking at what inflation has gone down this year, we've seen the cost of goods head lower here in 2024. We've also, for the first part of the year, saw energy prices head lower. That has spiked a little bit more amongst the conflicts in the Middle East, a little bit higher the past couple months, but we do foresee that actually trending downwards overall. And then one other piece we want to talk about is services. Services has become the primary component of the CPI index. Now, housing actually does fall under the services category, which is more or less a little odd from looking from the outside in, but it does fall under services. So when we look at this, we need these services to come down in order for us to get closer to our goal. So it's not just the housing market, but everything under that services category is really what we need to see start to lower. And then the other part to just mention is, food and energy. Well, they have drifted higher this year or the past couple months. The amounts that they've drifted higher is very nominal and not really a concern to us. It's more so services focused.
And just to chime in on that, other things that fall into the services category, those are things like utilities, insurance, right? Fees for hiring a plumber or someone to work on your house, right? These are all services, and those are the things that affect everyday people, right? So along with housing, a lot you can kind of notice prices at Target, Walmart, even food prices are kind of stabilizing. It's those other things. If you've looked at your insurance bill lately, your utilities, that are still really picking up. So, yeah.
Yeah. And then, further than that, we look at, kind of the growth here, right? So GDP has been supported, right? Our national GDP, right? Which is how we measure how strong or weak the economy is. We look at things that have been growing versus decreasing in the past quarter here. Services and service spending has been one of the better parts. So it's kind of this area where we want services to go down, but we don't want it to go down too much, right? But we have seen, as you can probably see in this chart, right, since June till now, that second quarter 23 till now, we've seen services increasing, but we've seen a lot of consolidation in a lot of the other categories here, like goods, right, and spending on goods. We've seen decreases in non-residential investments. We've seen decreases in government spending. We've seen decreases as well, or kind of a mixed bag, but in our net exports. Now that has decreased into the negative territory even at that here in 2024, which is also dragging things down. So we have, some other areas that we need to improve on so that our GDP stays high while they're trying to bring inflation down. And this is kind of one of those things that the Federal Reserve has a very tough job for themselves, right? To kind of balance the two, right? They need to bring interest rates down and they need to bring inflation down, but all the while they want to do this without sacrificing our national GDP, right? Because if that GDP starts to fall and unemployment starts rising more, that's where you get into a case of a recession, or if it gets more severe, a depression. And that's what they're trying to avoid. So they're trying to thread the needle between the two. And what we can see here is they can, as services spending goes down, it can't go down too much or too quickly, or that might course correct us a little bit too more and overcorrect into a recession. And that's what they're trying to balance.
Yeah, it's kind of a catch-22, right? It's, hey, we want to get some of these costs down so that inflation eases, but we also don't want to push us into negative GDP because then we're in a recession. And the other thing that plays into this that you'll notice as services spending has been increasing, look at the government spending here in orange. And this has been a big talking point, especially during election cycle, right? We're all aware that our national debt is up there pretty high. And so there's a lot of pressure to decrease government spending as well. And, that's been a big contributor to GDP growth over this last couple years. So again, as we kind of try to thread this needle to stop inflation but not go into a recession, these are going to be the things that we continue to look at. Speaking of GDP and how that's kind of grown over time, and additionally how it relates to debt, as I was just saying, is if you look at the S&P 500 here in kind of this brown color, and then debt to GDP in black, this is something that we're tracking as well, because we're all looking at the U.S. debt, and it's obviously at record levels, right? But what's more important than the overall debt is the debt in relation to GDP. So how much debt does the U.S. have in relation to how powerful, how strong the economy is? And
Mhm.
as you can see, we've actually, even though debt and GDP is, debt to GDP has been climbing, it's kind of kept pace with the S&P 500. The economy has been strong enough to make up for the fact that our debt is growing. But we're getting to this close point here where that's getting close to inversion. And so uh, yes, we've had a strong economy for a long time. Yes, we've been able to kind of avoid having any issues caused by the debt, but we're getting close to a point where you know it's becoming questionable, especially when you look across the world and you look at 20 developed economies so that are similar to the US, and you see, okay, how well, you know how well does that company grow? What is your GDP growth compared to your debt to GDP ratio? So how well does a company grow the higher their debt gets? And you can see at 90% and above, which is where we are right now, GDP growth is typically only about a 2% a year. Yes, it's still growing, and that's what we anticipate it to do, but it's more difficult to sustain high levels of growth with high levels of debt. And that, should be self-explanatory to most of us, makes sense. But again, is another part of this tightrope walk that we're doing right now as an economy. And yeah, I wanted to show this chart in here because I felt like we were being maybe a little negative on this commentary, more so than normal. And what we're not saying is that we expect an imminent crash because of all these issues. Okay. Um, we've faced this type of thing before. We've been through recessions. We've been through depressions. Uh, what we do know is it's nearly impossible to time when these things will happen. But what we also know is when they happen, the U.S. has a unique ability to get out of them even stronger than it began. And when you look at growth of the economy, growth of GDP since the 40s, you can see that, right? Highlighted in red are these recessions, and in gray. And every time it happens, the economy rebounds and winds up even stronger. And we have no reason to believe that this time would be any different. So we always like to show one of these charts to put things in a historical context, even though, yeah, we have some reason to be concerned right now. But honestly, what's kind of kept us alive is businesses, especially the large kind of growth oriented businesses, have been really strong and have been investing heavily. And we don't see any reason that's going to stop. So again, we wanted to kind of highlight this conversation on the difference between what a lot of Americans are feeling and what the economy is showing, and why that is. So David, why don't you wrap us up here, and then we can get to some questions if there are any.
Yeah. So kind of, as we always say, you want to maintain in your accounts, whether it's TSP or outside accounts, a balance between growth and value in your stocks. That is, companies that reinvest everything into further growth or value, which is going to be more dividend-based companies. You also want to be mindful of concentration risk, as we've talked about time and time again. Things like the market cap weighted indexes like the S&P 500 or the Russell 2000, which would be the C and the S at TSP. And then the other part that you want to consider is how to diversify some of this risk away. So if you are in TSP, you don't really have too many options, right? So if you have any outside investments, that's where you want to add some of these other diversifiers like a managed small cap, mid cap, or international fund. And don't be afraid to use bonds as a buffer, right? As we talked about, we are really kind of closing in on that point in time where interest rates will start decreasing as this inflation number comes down, and the bond market should be performing quite a bit better, easily better than the past few years, right? Which has been negative, but even further than that, we've been in a low interest rate environment for the past 25 years. And we are finally going to be in an interest rate environment that will be a little bit higher throughout. So that's where you want to make sure that you're not excluding bonds completely from your portfolio. And you want to make sure that you're doing this or incorporating them in based upon your risk level, based along your time horizon until retirement or time horizon until you need money from that account. And yes, Neil, we did get your message in the chat, so that is working. Now, for everybody else on the line, practical strategies would be don't let your emotions drive your decisions. Of course, once we get to a point where markets might head lower, it's too late to make changes, right? So you want to make those while markets are up and looking nicely like they do right now. You want to understand your risk tolerance. If you're not sure, there are a lot of tests online that you can take. We also offer a session that we'll talk about here soon, where you can have that tested for you. You want to be diversified in your investments. Don't put all your eggs in one basket or all your eggs in the S&P 500, for example. And stay invested, right? You don't want to try and time the market, especially as we approach the election here, and things might get a little bit more volatile. Make sure you check out our election presentation. We talk a lot about things that occur during election years and trends and historical information. And the overwhelming information is markets do better in an election year and markets do well the year after an election, usually, not always. So on that note, we do offer a free complimentary financial checkup. Here's kind of a list of several of the questions that we very commonly see. And these questions would be answered during this meeting and more. And this is also a great way to just kind of voice any of the questions or concerns you have about your own situation. So as part of today's seminar package, this is part of that is a complimentary meeting. There's a QR code or a link below that to register for that free meeting. And then, further than that, as we talked about, we also have on a further slide here, a link to our YouTube channel where you'd be able to come in and watch some of our other presentations, things even outside of our market commentaries that are more topic specific for what we do at various federal agencies for their employees. So we do have, as I mentioned earlier, the chat function. As I mentioned, you do need a YouTube account to ask questions there. If you are not signed into your YouTube account, it will kick you out if you try to go over there. But as mentioned, you can also ask us questions in this financial checkup, or you can definitely go to our website and submit any questions afterwards if you were unable to ask your question.
Yeah, we'll give it a minute here to see if anybody wants to type a question into the chat. We don't see any in there quite yet. But for those of you that are on live, feel free to type in a question if you have it. All right. Well, I guess we just did that good of a job, David. I don't see any questions coming in. So I think we'll go ahead and end it there. And of course, like David said, if you have questions, feel free to register for one of these complimentary financial checkups. That'll be with one of us or one of our other financial advisors or coaches. And yeah, hope to see you again next month. Thanks, everyone.
Yep.